bracing for a major pullback.
Stocks will crash and the economy will suffer.
Quickest and sharpest market crashes that we'd ever seen.
Major stock market crash.
Stock market is in a situation worse than the peak of the dot-com bubble.
Now I've got a lot of information to give you today, and because you're going to need plenty of time to go and set up that bunker at the bottom of your garden for the impending apocalypse, here's your timestamps. Oh, and remember, this is not financial advice. It's a tinfoil hat. Get it? My humour is wasted on you lot. Right, let's start with a very brief introduction. Well, I was actually adopted and raised by Inuits somewhere not far off the coast of Finland, and it was around this time that my love for maths and numbers really became apparent whilst collecting food for the hounds. Oh, sorry, not my background, a brief background of where stock markets are. Right, okay. If we look at the biggest global market first, the US, they're at all-time highs. The S&P 500 currently sits somewhere around 4,300 points, and the Dow Jones at 34,700. You get the idea. And whilst here in the UK, not quite so much, a bit like Tyson Fury rising from the canvas, we have shaken off the lion's share of the damage done by COVID-19, and in general terms, equities are doing rather well. We have been on a huge bull run for a long time now, and although we all like it when things go up, it can pose its own problems, something we'll come on to later on in the video. A bull run or a bull market is simply an extended period of time where stock prices rise in value. It's the opposite of a bear market, which is an extended period of time where stock prices fall in value. So markets are often described as either bullish or bearish, and although there's a lot of argument on where those terms exactly came from, it's pretty commonly accepted that it all comes down to how they would attack their opponents. A bull would thrust up with its horns, whereas a bit like fumbling around with a brand new Tinder account, a bear would swipe down. Me personally, I'd just kick you in the knackers and run away, but I'm not really that known for my combat skills. You see, the beauty of YouTube is for 99% of the time you see me sat down, so for all you know, I could be 6'3". Spoiler alert, I'm not. That's the bin men. I don't think they could be any louder. I'll just wait for them to finish. Quite done? No, you empty it a bit louder. Just trying to... Yeah, the cat. Yeah, okay. Good. But let's think about how the market has changed in recent years. If we look at the S&P 500, the 500 largest companies in the US, we've seen a huge shift into tech-based companies. The so-called mega cap S&P 500 technology companies, who are Apple, Microsoft, Amazon, Facebook, and Alphabet, now make up something like 23% of the overall value of the entire S&P 500. And whilst that doesn't necessarily mean that a crash is any more or less likely, the concentration could be an issue, i.e. a fall in the tech sector is now a big deal for the S&P 500, and we have seen a little bit of that recently through inflation fears, something we'll come on to in a moment. Now, I wanted to start really with a little bit about how the stock market works. You see, the stock market is not the economy, and the economy is not the stock market. What do I mean? Well, people often get those two things mixed up, and to be honest with you, there is very little or no correlation at all between what the stock market does and GDP. Never has this been demonstrated better than over in the US, where since March 2020, markets have rebounded enormously from COVID-19, and there's a glaring disconnect between what the stock market's doing and what the economy might be up to. Months later, and this disconnect is as deep as ever, with millions of us still plagued by the virus, and yet stock markets are still in a celebratory mood. You see, the stock market is, in many ways, a little bit like my wife and I when we discuss what's for dinner. Cue the infinite cycle of, I don't know, what do you fancy? I don't know, what do you fancy? Until the early hours of the morning where one or both of us starves to death. Markets are completely illogical, and fundamentals are often thrown out of the window. You'd likely drive yourself insane trying to understand how or why they behave in the way that they do. Does anybody else do that infinite dinner question cycle? In its simplest form, it is the basic principle, of course, of supply and demand. Something that's in low availability but high demand, the price will go up, and something that is in high availability but low demand, the price will go down. That's as true for the loaf of bread in your shopping basket as it is for the stock market. Now, let's go against the YouTube grain and try and look at this in a balanced way. Oh, shots fired. We're going to look at the bad news first, the reasons why a crash could be imminent. Then we're going to look at the good news, i.e., is there any argument to suggest that markets might continue to do well? We're then going to look at what you should do with this information as an investor, and I'm even going to be brave this week and I'm going to give you my thoughts, my prediction on what I think markets might do. Right, bad news first. You see, a market correction is defined as a fall of more than 10%, but not as much as 20%. The thing is, you won't really know you're in a correction until it's over. Once you've gone past 10% and you're therefore in a correction, you need to see how further it might fall. Otherwise, if it goes more than 20%, that's defined as a market crash. Potentially, it could then go on to become a bear market, which is a prolonged period of this falling prices. The value of the stock market in terms of GDP, or the output of the economy, is at all-time highs. Something often measured by the Buffett indicator, named after Warren Buffett himself. Essentially, by this measure alone, markets are overvalued. And if you were to take this on face value and just that stat alone, it would be quite easy to argue that a fall is due. Here comes the crash. But like everything, I urge you to get into the detail when considering a stat like that, because the GDP that's referenced there on the Buffett indicator only refers to US GDP. And although that's the biggest marketplace, markets are a huge global space now. So there are flaws in looking at that indicator on its own. PE ratios, price to earning ratios, are at the same high levels as they were right before the big crash in 1929 and are much higher than average. PE ratios are one way to value a company, showing you its share price relative to its per share earnings. And these being at very high levels is another reason that many argue a stock market crash is on the way. But stock market indicators aside for a moment, let's think about job prospects and unemployment. I do wonder, have we really seen the true effect of the COVID-19 pandemic on many businesses? I tend to think there are a huge number of businesses that are on life support, propped up by the government money and all the stimulus that's been thrown at them to keep them going. What happens when that comes to an end? Normally, when it comes to unemployment, things are cyclical, i.e., when things get better, people will get their jobs back. But you have to ask yourself the question, how many of these jobs have actually now been lost forever as technology has taken a front seat? If unemployment becomes a longer term issue, people will have less money to spend, meaning businesses will make less profit and the stock market could potentially fall in value. And I do think this is perhaps a bigger problem than some of the others that are more regularly spoken about. And while we're on the topic of all this stimulus and all this government money that has been pumped in to keep things going, one big concern is that it's driving inflation up. Although a degree of inflation is good and businesses actually rely on it, inflation getting too high or out of control poses a big problem. We saw markets, didn't we, have a little wobble fairly recently on the communication that some inflation figures had spiked upwards. And markets in general across the globe fell by around 4%, but interestingly, the tech sector fell by more like 10%. In fact, there were some notable falls. Peloton went down 34% and Tesla went down 31%. If inflation were to carry on in this vein, what would ordinarily happen is interest rates would rise in order to try and curb it. And this is really what markets are fearful of. Whether this spike in inflation is a short-term issue or the start of a longer-term problem is something that is well argued amongst my peers, and I can hear people making good solid arguments for both sides, whether it's just a short-term issue or whether it's here to stay. But ultimately, I think this point around inflation in the bad news section is probably the biggest one to keep an eye on. Now, also in this bad news section, I want to talk about generations. I've got 2 points to make on this. The first is, I do worry that there is a new generation of investors that have only really been involved in this prolonged bull market, and they're only used to things going one way. Up. And I think you might be in for a bit of a shock. So for those people out there that might fall into this category, just remember why you invested and be brave. But my second point, and perhaps the one that is more relevant to whether a stock market crash is imminent or not, is around the randy bunch that are the baby boomers. These are people that were born between 1946 and 1964, so they're between 57 and 75 years old. So my parents, although I'm really now regretting referring to them as a randy bunch. In the US, there's around 70 million of these baby boomers. And why is this relevant? Well, because they're all coming up to retirement. And what retirement usually means is waves of money coming out of their investments for them to spend. And we've never seen a generation of this size get to retirement before. The generation before, called the silent generation, well, there was only about 20 million of them in the US. That being said, I do think the impact of this is perhaps not as bad as some people might let on, because the way that people are retiring now is very different. People aren't pulling all of their money out of the market in one go to buy an annuity, say, and instead are living off their investments and retiring in different ways. So it could be an issue, but I wonder how big a one it may or may not be. Now, despite all this bad news, stock markets have always recovered and set new highs. Every single time. So, let's start to look at the good news. Let's have a think about why stock markets are not about to fall over and could continue to rise. Good news time. Legendary investor Benjamin Graham once said, "In the short run, the stock market is a voting machine, but in the long run, it's a weighing machine." The basic idea here is that the stock market is wildly inefficient over the short term. However, over the longer term, can follow fundamentals. The vaccine program, by and large, has been a huge success, especially in most major economies. And this has been welcome news for businesses and investors alike, as we start to perhaps think about shrugging off COVID and living with it amongst things that we live with naturally, like the flu each year. Many experts are actually predicting that we could see roaring markets over the remainder of 2021 as the final restrictions around COVID get lifted and people start getting back to even more activities and travel, etc. The money printing exercise that we've seen governments do across the globe is evidence that they are trying to do everything in their power to stop things falling over, and that includes the stock market. This commitment has been welcome news for businesses and in fact has kept many of them going that otherwise would have struggled. Don't forget, stock markets are forward-looking. They have their eyes on the road ahead, not the road behind. A lot of people are arguing that a lot of the negative news that is still lingering is already priced into markets, and there is a little bit of evidence of that in the UK here. The FTSE 100 was around 7,500 points before COVID, and in a matter of about 6 weeks fell all the way down to 5,190. And although it's recovered, not all the way, it currently sits around 7,100, so there's still 400 points to go to get back to where it began before COVID. And if you compare that to how US markets have performed, which are way over and above where they were pre-COVID, you could make an argument that there is some value here in the UK and there is still a good news story to be told for future investment growth. So with all this noise in mind, what should you do as an investor? Well, the truth of the matter is there is only one truth that you really need to know. And it is simple. And it is that no one knows. Not this guy.
I thought he was gone forever.
Not this guy.
They couldn't find a virgin either, but that's another problem.
Certainly not this guy.
They have very little credibility.
Oh, and while we're at it, just to be clear, not this guy either. If markets really could be measured and predicted consistently, you could make an argument that a stock market crash has been on the cards since 2010. One thing people suggest that you do all the time, especially here on YouTube, is benefit from both directions, i.e. profit when markets are going up and also take advantage when markets go down. It's in the phrase buy the dip. And this is good advice, although does have its own pitfalls and flaws in my opinion. In order to benefit and to make the most of a falling market, you need cash. You need cash to buy the stocks after they've fallen and to ride the recovery back up to where they were and beyond and profit from that market crash. The problem is waiting for a market correction can be a fool's game, and to be honest, more people lose money waiting for a correction that never comes than they do by gaining from one. Also, how much cash should you keep aside for such an event? 5%? 10%? 20%? You see, while you've got cash, it's not performing, so how much should you keep aside? How much is too much? The truth is, everyone will give you a different answer. People always talk here about pound cost averaging or dollar cost averaging, and it is a very useful tool. This is where you buy in at numerous points over a period to take advantage of market dips. But the truth of the matter is that if you follow the assumption that stock markets over time tend to go up more than they go down, then actually I think you'll find that lump sum investing mathematically tends to favour the longer term investor. There's a video topic for another day. It's like when Christmas comes around and I refuse to pay the December prices and I'd rather wait for the January sales. Romantic, aren't I? But what happens if the January sales didn't come by and in fact prices went up? Now I've got to spend more money and I've got a pissed off wife who's waited longer than she'd like for her scented candles. I'm only joking. I don't buy her scented candles. They're far too expensive. So let's end on the what do I think. Remember, you can't control the stock market, but you can control your reaction to it. Honestly, on balance, I would be really surprised if there was a stock market crash for the remainder of 2021, but that is only my opinion, and honestly, I could be very, very wrong. I will be ready either way. I do have a little bit of cash that I will invest if something does happen like that, but I am by no means sat on a large cash stockpile because I'd rather be invested than not. I'm well aware, a bit like Madonna, opinions like that age pretty badly. So I look forward to revisiting the comments section in a few months' time or next year where everybody is filled with, how wrong were you, idiot.
Thank you. Thank you. It's so great to be here.